Welcome to our podcast where we delve into an important topic impacting every business alike, which is complex world of taxation and importance of transparency in ensuring trust and accountability. I am your host Riddhi Shah, and today we have with us Prayag Kinariwala, Senior General Manager, Taxation in Lupin Limited, an expert in tax law.
Thanks Riddhi for inviting me on this podcast. I'm excited to discuss this important topic of tax transparency.
So let's dive right in. Tax governance constitutes an important portion of corporate governance, making tax transparency a prominent subject lately. As a tax expert, how crucial do you think is tax transparency in today's environment?
In recent years, there is a remarkable rise in environment, social and governance initiative driven by heightened scrutiny from shareholders, government and consumers. Two important pillars of ESG are society and governance. Tax plays a very important role to society and government. Let's begin by simplifying the concept of tax transparency. Tax transparency refers to transparent communication of tax strategy and tax payouts. This includes detail about how you approach to tax, how you communicate about your tax principles, tax compliance framework, tax governance framework, tax advocacy, tax engagement, and tax paid in different jurisdiction by your all subsequent entities. In today's landscape, tax transparency holds significant importance. Stakeholders ranging from customers to investors now evaluate companies through new lens, often considering ESG scores or ratings. These ratings incorporate tax transparency as an important component of their evaluation criteria. Through tax transparency reporting, companies not only demonstrate their commitment to integrity and good corporate governance practices, but also enhance transparency and accountability to their stakeholders.
I agree. Over the years, many governments and tax regulators have issued varying guidance on the nature, form and extent of tax transparency. The journey of tax transparency started in 2014 when EU issued a Capital Requirement Directive 4, an transparency initiative for bank and capital markets. In 2015, OECD issued BEPS, which led to the introduction of country-by-country reporting. HMRC announced a requirement for UK businesses to publish tax strategy in 2016. GRI developed a new standard on tax in 2019. This year onwards, EU's public CBC requirement has come into effect. In India, the tax transparency reporting is currently voluntary, yet many corporates have acknowledged its importance and have gone ahead and published tax transparency report along with their annual reports. So since you have assessed transparency needs of your business, what information do you think stakeholders typically value?
For effective reporting, business should comprehensively document tax principles, tax governance, and tax strategies which is aligned with its corporate objective. This includes clear communication of its approach to tax planning, engagement with tax authorities, and adherence to local laws and regulations. Just giving the fancy statement will not help. You have to demonstrate your disclosures through examples. For example, if you say we don't set up your foreign subsidiary companies in low tax jurisdiction only without business substance, then you should demonstrate what was the other objectives which you use when you take a decision to set up companies in the low tax jurisdiction. Further, when assessing transparency needs in respect of payout of taxes, it goes beyond the corporate tax. You give reporting of tax borne and tax collected, which includes all type of taxes, custom duty, local levies, stamp duty payments, social security contribution, withholding tax which is deducted from employee payments from vendors. Whereas in further you have to report country by country reporting in respect of all the jurisdiction in which you operates, which includes revenue from related party, revenue from third party, profit after tax, current tax, tax actually paid, what assets you are holding in that particular jurisdiction, how much employee there in that jurisdiction. Everything is to report in tax transparency report. Further, you can also give reconciliation of effective tax reconciliation with reason why there is increase or decrease as compared to the previous year.
I understand both quantitative and qualitative disclosures are important. Reflecting on your journey, what challenges did you encounter and how do you suggest in overcoming them?
Challenges may arise from navigating complex tax laws across jurisdictions, ensuring accurate and comprehensive data collection in short period of time, addressing potential reputation risks, and managing stakeholder expectations for transparent and meaningful disclosure. Gathering and managing large volume of data required for tax reporting can be daunting, particularly for companies with complex organized structures and having a decentralized operation. Ensuring the accuracy and consistency of data across different jurisdictions and systems can be a significant challenge. As you know, we have to publish this tax transfer report along with our annual report. So you will get just 2-3 months to prepare this TTR. To address this challenge effectively, a proactive approach is essential. Collaboration with internal stakeholders and advisors can help companies to navigate some of these complexities.
Absolutely. It is evident that embracing tax transparency reporting is a strategic move towards building trust with the stakeholders and showcasing a commitment to ethical business practices. While challenges such as navigating intricate tax landscape and balancing transparency with competitive interests persist, businesses that proactively address these hurdles stand to benefit from enhanced credibility, improved risk management, and strengthened relationship with investors, customers, and communities alike. Thank you, Prayag, for this insightful discussion, and thanks to our listeners for joining us on this insightful journey.